Good afternoon and welcome to Bulls, Bears, and the Bell. Thank you for joining us. When you looked at the market tape for Monday, October 6, 2025, your brain might have just short-circuited.
Right.
It felt like two completely different decades were happening on the same trading floor simultaneously.
Yeah.
You had euphoria and, well, sheer terror, almost.
Exactly.
Welcome to this deep dive, where we take your source material and try to untangle the, frankly, unbelievable paradox that defined this market day.
It was a day of absolute, almost unbelievable extremes. I mean, on one hand, you had the technological ecstasy, the NASDAQ composite, the S&P 500, both hitting brand new all-time highs.
Record highs.
Yet, at the exact same time, traditional safe haven assets were also just screaming higher. Gold briefly surpassed, what, $3,900 an ounce?
Incredible.
And Bitcoin surged past $125,000, setting its own dramatic new record. Just wild swings.
That is the ultimate paradox we really have to unravel for you today. How can investors be so aggressively setting new records in growth indices while simultaneously pouring money into traditional safe havens and speculative digital hedges?
Yeah.
This isn't just cognitive dissonance. This feels like a highly structured strategy that, well, it speaks volumes about market anxiety.
Our mission today is to break down this highly bifurcated market environment using the daily market intelligence report and some subsequent context pieces. This really wasn't a simple risk-on or risk-off day.
Oh.
It was the ultimate demonstration of the barbell strategy in action. You know, think of the barbell. Heavy weights on both ends and almost nothing in the middle.
Okay, so the two heavyweights being?
On one end, you've got massive, highly concentrated bets on secular transformative growth themes, namely AI. Investors seem to believe this sector is almost immune to traditional economic gravity. On the other end, the second heavyweight is this comprehensive, aggressive hedge against a truly wide array of persistent macroeconomic and political risks that just refuse to dissipate.
Like what?
We're talking about the ongoing government shutdown, sticky inflation, geopolitical instability, and maybe most importantly, the extreme uncertainty surrounding future Fed policy. You, the listener, need to understand that this structure, this pursuit of growth and aggressive hedging, is really the central theme of 2025. It reflects a profound combination, well, optimism about technology and this deep underlying anxiety about pretty much everything else.
Okay, let's unpack this then.
Yeah.
How can the market be so happy and so anxious at the exact same time? I think we need to start with the happiness, right? The engine that drove the major indices higher and completely drowned out the noise of the political risks. The AI story.
Absolutely. The primary massive tangible force driving the market on October 6 was a monumental piece of corporate news. The landmark strategic partnership announced between Advanced Micro Devices, AMD, and the generative AI leader OpenAI.
Huge news.
This wasn't a rumor or a forecast. This was concrete, future-defining business.
And the market reaction was just explosive. AMD shares absolutely soared, increasing their value by nearly a quarter in a single session. They closed the day at $203.31, an astonishing gain of, 23.48%.
Yeah.
This wasn't just typical AI hype either, was it? This move felt driven by the specific mechanics of the deal, which seemed to show a really profound long-term commitment.
It was a game changer because of the sheer scale and the strategic implication. The deal commits AMD to supplying its high-performance GPUs, the absolute necessary muscle for large language models, to power a staggering 6 gigawatts of OpenAI's critical AI infrastructure.
6 gigawatts, that sounds like a lot.
6 gigawatts. To put that in perspective for you, that is the equivalent power capacity of several major metropolitan areas combined. It's an enormous commitment of resources and capacity. It signals that AMD has, well, finally reached the level of infrastructure reliability that a giant like OpenAI requires.
Okay, the market loves a big contract, sure. But what truly cemented this, what turns it into like a generational story rather than just a massive order, is that really unusual warrant detail. This feels like financial engineering meeting supply chain management.
That is precisely the right analysis. The warrant transforms this from just a transactional agreement into a true strategic alliance.
Oh, so.
The deal includes a warrant that grants OpenAI the option to acquire a significant stake, up to 10% in AMD. Now, if you're OpenAI with massive cash requirements for scaling, acquiring a 10% stake in a company that just saw its stock jump past $200, well, that's a huge financial commitment.
Right. Isn't a 10% stake in a $200 plus stock a massive financial risk for OpenAI, or is this really about something else, like securing priority allocation of next-gen chips?
It is absolutely about securing priority allocation and, crucially, long-term supply stability. Think of the context. We have a chronically constrained market for AI hardware, dominated for years by, well, one competitor. Exactly. By taking a stake, OpenAI ensures two critical things. First, they are hedged against future extreme price hikes for AMD's cutting-edge chips. Second, and arguably more vital, they ensure they are at the absolute front of the line for a priority allocation of next-generation chips.
Which is everything in this field.
Everything. Winning means always having the newest, fastest compute power. So this warrant structure, it cements AMD as a dedicated supplier and transforms their partnership into a deeply intertwined long-term strategic alliance. It validates AMD's technology on a monumental scale.
And that validation has immediate competitive implications for the undisputed heavyweight champion of the sector, NVIDIA.
Absolutely. The market immediately viewed this partnership as positioning AMD as a, quote, formidable competitor to NVIDIA in the lucrative, high-margin AI accelerator market.
And NVIDIA stock reacted.
It did. While the broader excitement pushed the PHLX semiconductor index, the SOX, to a new all-time high, so, a rising tide lifted most boats, the market leader, NVIDIA itself, actually declined 1.07% on the news. This was a clear reflection of legitimate concerns over increased competition and the potential for maybe some market share erosion down the line. It's a classic case of the overall sector benefiting, but the competitive dynamics shifting underneath.
This brings us back to that core belief underpinning these massive valuations, doesn't it? This AI story isn't just about quarterly earnings. It's framed as the future of global growth.
Correct. The market is willing to pay these high prices because of this overwhelming belief in the AI productivity thesis. We are seeing market strategists across the board, like Young-Yu Ma, chief investment strategist at PNC Asset Management Group, explicitly calling AI the question of the decade.
The question of the decade, wow.
The conviction is that the anticipated massive productivity benefits generated by AI, efficiency gains, cost reductions, entirely new revenue streams, can fundamentally justify these high valuations. And perhaps even more critically, they believe this growth can help countries counter the massive rising global debt levels that have plagued the economy for the last decade or so. The market sees AI as, well, potentially an economic savior, capable of generating growth regardless of whatever short-term policy headaches the Fed or Congress throws at us.
But wait a second, isn't that just classic FOMO, fear of missing out, dressed up as a productivity thesis? I mean, if AI is truly the savior, why are we seeing so many headlines about tech giants laying off thousands of workers? Where's the evidence of massive productivity gains right now to justify those PE ratios?
That is the essential tension. You have to recognize that. The market is pricing in the future benefit, not the current realization.
Okay.
While large companies are, yes, laying off support staff and focusing capital solely on AI infrastructure, which is why the semiconductor index is soaring, the promised broad-based economic productivity gains are still largely theoretical at this point.
So it's a bet.
It's a huge bet. However, the institutional money feels like it can't afford to be skeptical, because if the thesis is right, the penalty for missing this rally is just massive. They are essentially betting that the promised efficiency gains are coming, and crucially, that the cost of capital, the interest rate environment, will remain low enough to bridge the gap between today's price and tomorrow's profits.
A lot needs to go right there.
A whole lot. And that concentrated AI optimism, when it crashes into this broader macro anxiety, that resulted in an extreme, very visible bifurcation in performance, evident across all the index and sector reports for the day. This is the structural result of that barbell strategy we talked about.
Right. Let's detail that index divergence then. The headline indices looks great, but the details tell a much more selective story about market health, don't they?
They absolutely do. The leaders were clearly growth-oriented and tech-heavy. The NASDAQ composite led the charge, gaining 0.80% to close at 22,962.23, achieving that new record high.
Impressive.
The broader S&P 500 followed, closing up 0.39% at 6,741.87, also hitting a new all-time high during the session. It felt like a bull market just looking at the numbers.
But lurking beneath that enthusiasm was a very pointed technical warning that speaks directly to the maybe frenzy of the moment.
Yes. The speed of the rally was concerning to some analysts. The NASDAQ composite's momentum was so strong that its relative strength index, or RSI.
That technical indicator.
Exactly. A key technical indicator used by institutional traders to measure the speed and change of price movements. It moved above 70.
And 70 is the magic number.
For a sophisticated investor, an RSI above 70 is traditionally interpreted as indicating potentially overbought conditions. It suggests that the pace of the rally might be unsustainable or, due for a severe pause or even a correction.
Okay, for our listeners, does the RSI really matter when fundamentals like a 6 gigawatt supply order are driving the rally, or is this just noise for momentum traders?
It matters greatly because it reflects emotional intensity, the crowd behavior. While a massive deal is the catalyst, sure, the RSI tells us that everyone rushed in at once, often using leverage.
Wow.
If we look back at historical precedents, particularly in late 2021, before that sharp market correction, the Nasdaq frequently touched and lingered above the 70 RSI threshold. It signals that maybe all the good news has been priced in very, very quickly.
Leaving it vulnerable.
Exactly, leaving the market highly vulnerable to any negative news, even a small policy disappointment, because there might be few buyers left at current prices. The technical warning is essentially flagging the market's fragility.
And the blue chip index, the Dow, told a completely different story about the overall health and breadth of the market.
It certainly did. The Dow Jones Industrial Average, representing more traditional industrial and financial blue-chip America, actually finished the day in negative territory. It declined 0.15% to close at 46,686.101. This really highlights the narrow, selective nature of the rally. The Dow was weighed down by losses in specific components like Verizon, which fell 3.2%.
Why Verizon?
They announced the appointment of Dan Schulman, the former PayPal CEO, as its new chief executive. Leadership transitions often inject initial uncertainty, and in a market focused solely on AI, those non-AI related setbacks can loom large.
Okay. However, we can't say it was only the mega cap AI names winning.
Yeah.
Small caps finally got off the mat, right? A bit of good news there.
They did, and that's an important nuance. The Russell 2000, the index tracking smaller, generally more domestically focused companies, also participated. It closed up
A
0.55%.
new record.
It even hit a new record after what had been a nearly 4-year recovery period. This suggests that the belief in the AI productivity wave and maybe anticipation of Fed cuts has finally started to bleed out a little into the broader economy. It provides a small but welcome sign of breadth, even if the sector focus remains heavily skewed.
And that skew is crystal clear in the sector scorecard. The performance gap was absolutely dramatic.
Just look at the numbers. Information technology, INFT, was the undisputed outperformer, surging 1.43%, directly fueled by that AMD OpenAI news.
Okay.
Now contrast that with the bottom of the scorecard. Defensive, interest rate sensitive sectors were absolutely punished. Real estate, real, was the worst performer, falling 0.74%.
Ouch.
Followed immediately by consumer staples, COS, which declined 0.58%. This shows investors were fleeing the supposed safety of utilities, staples, and real estate sectors that often do poorly when rate cuts are anticipated, but are generally stable, to chase the explosive returns offered by the AI theme.
Which brings us inevitably to the other side of that barbell.
Yeah.
If investors are so confident in the future of AI, why are they also buying up hedges like the financial system is on the verge of collapse? This is where it gets really interesting.
It is.
You said the strength in gold and Bitcoin serves as a barometer of the underlying anxiety.
Precisely. Let's look at that cross-asset anxiety hedge. Gold extended its powerful rally, trading near $3,980 per ounce. This incredible surge isn't just a simple rate cut story. At these price levels, we're nearing $4,000 here. You are seeing demand fueled by two major factors. First, strong safe haven demand spurred by political dysfunction, specifically the U.S. government shutdown, now in its 6th day.
Right, to shut down.
Second, widespread expectations of Fed rate cuts, which lower the opportunity cost of holding non-yielding assets like gold. Makes it more attractive.
Okay, but given that gold is near $4,000, are we sure this isn't less about the Fed and more about genuine, escalating geopolitical risk, or maybe even persistent central bank buying? Let's not assume the Fed is the only driver here.
That is an absolutely necessary clarification, yes. At this magnitude, it is certainly not just the Fed. The sources do indicate that recent aggressive central bank buying, particularly from non-Western nations looking to diversify away from the U.S. dollar, has created a kind of fundamental floor for gold prices. Coupled with persistent global conflict risks, gold is acting as a dual hedge. Protection against monetary policy failure, like inflation or a weak dollar, and protection against geopolitical instability. The $3,900 price point signifies, potentially, a structural shift in demand, not just a cyclical one based on rate speculation.
Interesting. And Bitcoin played its role as the digital speculative hedge, the new age gold standard, maybe.
You could say that. It soared to a new all-time high of $125,284 before settling around $124,673. Bitcoin benefits from this unique cocktail of factors that make it a perfect modern barbell asset.
Gotcha.
It benefits from the expectation of a weaker U.S. dollar outlook tied to Fed easing, strong technical momentum, and these persistent signs of increasing institutional adoption like new ETF flows and banking integration.
Right.
The simultaneous record highs in growth stocks, gold, and Bitcoin just underscores the market's hyper-defensive but also hyper-speculative posture. Investors are making big growth bets, but they seem terrified of what happens if those bets go wrong or if the macro environment collapses under the weight of debt and political infighting.
So the market spent all day celebrating the AMD deal. But in the background, the U.S. government shutdown was officially in its 6th day. In almost any previous cycle, that would have crushed confidence. Why is the market just shrugging off something that usually guarantees volatility?
Well, the market's behavior seems rooted in history here. The consensus view, which is supported by historical precedent, is that government shutdowns typically have a limited and transient impact on the broader economy and financial markets.
As long as they don't drag on too long?
Exactly, provided they don't last longer than a few weeks. It certainly causes operational headaches. We are already seeing delays in the release of key economic reports like retail sales and inflation data, creating a sort of information vacuum.
Which isn't helpful.
Not at all. But investors are betting that Congress will inevitably find a short-term solution before any permanent economic damage is done. The risk is considered, for now, political noise, not economic reality.
So investors are willing to assume the political risk will just blow over, but they are much, much more focused on the Fed. The narrative here seems to be that the central bank is poised to cut, and that dovish expectation is the true backstop for the rally. That's the real source of confidence, isn't it?
That is the crucial pillar supporting this entire lofty market structure. If you look at the Fed funds futures market, traders are pricing in an astounding probability, greater than 95% of a 25 basis point interest rate cut at the FOMC's late October meeting.
95%, that's conviction.
And an over 80% chance of a subsequent cut by December. This unwavering belief in monetary easing is what allows investors to pay extremely high multiples for stocks, particularly growth stocks, because lower rates increase the present value of future earnings so dramatically.
But this unwavering conviction is creating the major, almost self-inflicted risk factor we highlighted earlier, this potential feedback loop, as our sources point out.
This is the real danger, and it requires a deep understanding, I think. Investors are ignoring clear present risks. The shutdown, stretched valuations, geopolitical tension, precisely because they are so confident the central bank will provide that policy backstop. They expect cheaper money soon.
Right.
But this very behavior, this relentless buying, driving the market to new record highs, and the resulting easing of financial conditions, that's the problem.
Okay, let's define that term for the listener. What exactly does eased financial conditions mean in practical terms, and how does the stock market cause it?
Right. Financial conditions are basically a measure of how easy it is to access credit across the economy. When stocks are roaring like this, corporate bond issuance becomes cheaper and easier. Credit spreads? That's the difference between the yield on riskier corporate bonds and safe government bonds. They tighten significantly.
Making borrowing cheaper for companies.
Exactly. Additionally, high stock valuations make company assets look stronger on paper, which encourages more lending and borrowing throughout the system. When conditions are easy like this, the Fed's previous interest rate hikes start to lose their impact because businesses and consumers can effectively borrow their way around high official rates. The rally itself acts as a kind of stimulus.
Okay, I see.
So this self-generated easing of financial conditions could paradoxically give the Fed reason to delay or maybe soften its planned easing if they view the market's current euphoria as inflationary or potentially destabilizing to their inflation targets.
So the market, by getting too excited about guaranteed rate cuts, might actually be preventing those very rate cuts from happening. That's like a dog chasing its own tail, except the tail is made of dynamite.
It is the ultimate market irony, isn't it? Fed Chair Powell has explicitly warned that policy could be adjusted if inflation remains stubbornly above their 2% target.
And a booming stock market doesn't help inflation.
No, a roaring stock market, particularly one showing signs of speculative froth, is the exact opposite of what the Fed wants to see if they're trying to cool aggregate demand. They view asset price inflation as a wealth effect, which stimulates spending and undermines their goals.
Right.
Consequently, the market is, arguably, not adequately pricing in the risk of a hawkish surprise in the coming weeks. They are treating the Fed as a passive responder to economic data, when, in reality, the Fed watches market behavior just as closely.
And speaking of froth, we absolutely must address the sheer valuation concerns amid this AI-fueled climb, particularly when you compare to previous bubbles.
Valuations are deeply historically stretched. The Shiller price-to-earnings ratio, or the cyclically adjusted price-to-earnings CTE ratio,
The long-term one.
yes, it smooths out earnings over a decade to give a clearer long-term view. It suggests the S&P 500 is trading near its most expensive level since the infamous dot-com bubble of 2000.
Since 2000.
For our knowledgeable audience, the only time it has been materially higher was during the peak frenzy of 1999-2000. Stock prices are simply outpacing the rate of profit growth at an alarming rate, demanding near-perfect execution for years to come.
And it's not just the mega caps leading the charge into the stratosphere, is it? We are seeing speculative behavior bubble up in smaller pockets, too.
Precisely. Anne Maletti, head of equity investments at Allspring Global Investments, has expressed pointed concern about little bubbles forming specifically in speculative, often unprofitable, smaller companies.
Well.
These smaller, higher-risk names, often in nascent technology or maybe clean energy, are seeing massive volume and price appreciation without the underlying stability of solid revenue or actual profitability. It's kind of reminiscent of the meme stock frenzy, but driven now by AI enthusiasm rather than social media coordination.
This makes the upcoming Q3 earnings season a true stress test then. The companies absolutely have to perform to justify these valuations. A respectable 7.9% to 8.0% year-over-year EPS growth forecast sounds decent on the surface, but is it enough to sustain a market valued like the year 2000?
That is the central question hanging over the next 3 weeks. While 7.9% to 8.0% is respectable, it is largely driven by just a few mega-cap names.
Right.
To sustain a rally where the Shiller PE is this high, you really need earnings growth well into the double digits and probably acceleration into the next year.
So the pressure's on.
Immense pressure. To avoid a significant correction, corporations must not only meet these expectations, but also provide extremely confident forward guidance. They need to demonstrate they can successfully navigate persistent inflation and those rising tariff-related cost pressures that are impacting supply chains globally.
And if guidance disappoints.
If guidance disappoints, the market structure, which is entirely based on future potential, could quickly crumble, particularly since we already have that overbought technical signal flashing yellow.
Okay, beyond the giants like AMD and NVIDIA, the daily movers gave us a pure, unvarnished peek into the speculative nature of the trading environment. Let's spotlight some of those corporate movers that maybe embody that little bubble concept you mentioned.
Yeah, we saw some genuinely bizarre movements that day, illustrating that speculative froth. For instance, Critical Metals Core, ticker CRML, surged an astonishing 46.80% on high volume.
46%. On what news?
Crucially, there was no specific news catalyst reported for the day. This is a classic signal of speculative herd behavior, where traders pile into low-float, potentially heavily shorted stocks, just hoping for a massive, rapid pop.
Pure speculation.
Pretty much. Similarly, Solid Power gained over 34% on high volume. This shows the intense search for the next big speculative story, even in the absence of fundamental news.
On the other hand, we did have moves driven by concrete developments, or, in Tesla's case, some expertly managed teasing.
Right. Tesla, ticker TSLA, gained 4.00% after teasing a Tuesday event on social media. The speculation immediately centered around the unveiling of a new, lower-priced EV model,
Which the market wants.
something the market has desperately wanted as competition in the affordable EV sector heats up. The anticipation alone was enough to fuel a significant rally.
And then on the downside, the competition news immediately hit NVIDIA, causing that 1.07% decline we discussed. But we also saw other big movers like Verizon. VZ shares fell 3.28% after the company named former PayPal CEO Dan Schulman as its new chief executive. Why the negative reaction to a highly accomplished new leader seems odd.
It often comes down to two things, I think. First, investors generally dislike uncertainty, and a new CEO, no matter how accomplished, represents a potential shift in strategy.
Okay.
Second, Schulman is known for his fintech background, right? So the market immediately started speculating on major strategic pivots, perhaps a shift away from core telecoms into banking or consumer payment services.
And Verizon investors maybe don't want that.
Investors in a blue-chip company like Verizon often prefer stability and dividend certainty over radical strategic shifts, leading to initial apprehension and sell-offs.
Makes sense. We also saw significant M&A activity in the banking sector, hinting at larger trends there. Fifth Third Bancorp acquiring Comerica for nearly $11 billion. Why this consolidation now?
This signals a pretty significant trend within the U.S. regional banking sector. Following the banking turbulence of 2023, the regulatory environment has become significantly tougher, and the need for scale is paramount.
Get bigger or get bought.
Essentially. Comerica, known for its strong commercial banking operations, was a desirable target. The acquisition allows Fifth Third to increase its scale and efficiency, strengthen its balance sheet against future economic shocks and regulatory requirements. It tells investors that consolidation is not only ongoing, but probably accelerating,
Meaning more deals could be coming.
suggesting that smaller regional banks may increasingly become potential targets for larger institutions seeking to expand their geographic footprint or specialized market share.
Yes. And the options activity, did that confirm the extreme leverage and speculation running through the market?
It did, providing further evidence of that speculative little bubble. We saw significant bullish positioning, particularly in out-of-the-money calls.
Those are risky bets.
Very risky bets on substantial price increases that are far above the current price. Companies like Ever, saw option volume running over 300 times its daily average.
300 times.
Yeah. This suggests institutional and high-risk traders are placing huge, leveraged bets on rapid, volatile upside moves, which just heightens the potential for sharp, sudden corrections if the market turns.
Okay, let's briefly touch on global markets before we zero in on the crucial events this week. International markets seem to be largely deaf to the U.S. market euphoria, driven instead by internal politics, it seems.
That was the defining international characteristic, really. Global financial markets were quite decentralized that day. We saw Japanese stocks jump following a domestic political shakeup, reflecting optimism about a new cabinet. Conversely, French stocks slumped significantly on their own local political and fiscal news. Furthermore, in currency markets, the Japanese yen fell sharply after the election of a perceived fiscal dove, someone expected to pursue looser spending policies, which typically devalues the currency.
So local news trumped global themes.
It reinforces that local political outcomes are currently very potent drivers for foreign exchange and international equity volatility, maybe even more so than the U.S. government shutdown or even the big AMD news.
Now let's pivot to the critical events calendar. Given the fragility of this barbell market and the extreme dependence on the Fed, this week is arguably the most important of the quarter.
It is entirely backloaded with high-impact events centered squarely on U.S. monetary policy. The two pivotal events are Wednesday's release of the September FOMC meeting minutes and Thursday's highly anticipated speech by Fed Chair Powell.
Okay, what are investors scrutinizing in those minutes? We know they want the rate cut discussion, but what specific nuance really matters here?
They will be intensely scrutinized for details on the internal debate surrounding the Fed's first rate cut of 2025. Investors are looking for any dissent among policymakers, who is arguing for waiting versus cutting immediately.
The hawks versus doves.
Exactly. But the critical nuance, I think, will be the language used around tariff-related inflation. Those tariffs have been a persistent drag on corporate costs, raising the prices of goods.
Right.
If the Fed signals those inflationary pressures are temporary, maybe driven by policy rather than structural demand, it strongly supports the dovish narrative and justifies a cut. If, however, they signal those tariff costs are feeding into broader inflation expectations, the whole dovish assumption falls apart.
A lot riding on the wording. And Powell's speech on Thursday. That's where we get the real-time interpretation, I suppose.
That speech will be absolutely critical because it provides the market with a real-time risk assessment from the chair himself. A clear, dovish tone could add fresh fuel to the AI rally, validating the growth side of the barbell. However, any hint of hawkishness or any expression of concern about the market's current euphoria or the stretched valuations or that easing of financial conditions we just discussed, that could trigger a swift and severe reversal.
So Powell holds the pen.
Given how dependent the market is on the idea of cheap money, Powell's words could absolutely be the pin that pricks the speculative froth.
We also have the start of Q3 earnings season ramping up, featuring some consumer-facing heavyweights this week, which should give us a read on consumer strength.
Indeed. We are looking at PepsiCo, PP, and Delta Airlines, DAL, later in the week. For PepsiCo, analysts anticipate a challenging quarter. Wall Street is forecasting a slight year-over-year decline in earnings per share.
What are the headwinds for Pepsi?
We need to watch for pressure from sluggish U.S. demand, some softness in key international markets, especially Europe, and those higher costs stemming from tariff policies which erode their high-margin brands. Their guidance on pricing power will be absolutely vital.
And for Delta Airlines, DAL, what are the key metrics for investors to watch there?
The focus will likely be less on the immediate number. Analysts are expecting largely flat year-over-year earnings and more on their commentary regarding travel demand heading into the crucial holiday season.
Forward-looking.
Exactly. Investors will scrutinize forward booking trends. Specifically, watch their metrics related to cost control. Fuel prices have been erratic and revenue per available seat mile, or RASM.
RASM, what does that tell us?
If RASM is under pressure, it suggests they are having to cut prices to fill seats, indicating potentially softening consumer spending, which would be a huge concern for the broader economic outlook.
Okay, a lot to watch there. So let's bring this deep dive all back together then. The key narrative of October 6 was technology growth, primarily driven by that massive AMD-OpenAI partnership and the resulting AI euphoria, pushing major indices to record highs.
Right.
But that growth narrative is fundamentally brittle due to the extreme disconnect, that barbell structure between those record valuations and the persistent macro risks, namely government shutdown and the Fed's uncertain, highly scrutinized path.
It really boils down to one simple truth, I think. The market is employing the barbell strategy because it feels it requires both maximum exposure to growth and maximum protection against disaster.
A difficult balancing act.
Very. If the AI narrative falters, if earnings disappoint in the coming weeks, or if the Federal Reserve signals a more cautious stance than the market has anticipated, the growth side of the barbell could face a rapid, severe repricing.
Meaning sell-offs.
Yes. This dependence on the Fed's dovishness to ignore current risks makes the entire structure incredibly fragile. It could potentially trigger a sharp, market-wide de-risking event where both stocks and those speculative hedges like Bitcoin sell off together.
So what does this all mean? The core knowledge takeaway for you, our listener, is that the market's reliance on the belief in forthcoming rate cuts is the primary justification for ignoring the highest valuation since the dot-com bubble and, well, a looming government policy disaster.
And that leads directly to the final provocative thought we want to leave you with. The market's aggressive rally, fueled by this overwhelming belief that the Fed will cut rates soon, has created the exact conditions, eased financial metrics, market euphoria that the Fed usually combats.
The irony we discussed.
Exactly. Is it possible, then, that the market's primary bullish conviction, the anticipation of rate cuts, is now the very thing that will cause the Fed to delay those cuts, effectively turning the market's greatest strength into its greatest immediate fragility?
Question hanging over everything.
It's a risk investors will be grappling with all week as they await the outcome of the FOMC minutes and, of course, Chair Powell's speech.